Welcome to Talk Tickers. Today, we're diving into the Q4 2025 earnings call for Leslie's Inc.
All right, let's just rip the Band-Aid off. The headline number, it looked like a total disaster. Leslie's reported an adjusted earnings per share that missed what analysts were expecting by, get this, almost 92%. Ouch.
But here's where it gets wild. On the very same day, the stock didn't crash, it surged over 21%. I mean, what a classic disconnect, right?
So you've got this massive earnings miss on one hand and a huge pop in the stock on the other. It just makes you ask, what in the world is the market seeing that we're not? Well, that's exactly what we're going to break down today. It seems Wall Street is looking right past that ugly headline number and betting on a comeback story.
Okay, so let's roll up our sleeves and really get into these numbers. We've got to figure out what's hiding behind that huge loss, because that's the key to understanding why investors didn't just run for the hills.
Okay, so here's the deal. You have to understand the difference between GAAP accounting and what we call adjusted earnings. That scary-looking loss of over $17 a share, that wasn't the company actually losing that much cash. Nope. It was mostly a non-cash accounting charge. Basically, they had to write down the value of some of their assets on paper. So think of it as a paper loss. The adjusted profit, well, yeah, it was still a huge miss. It gives us a much clearer picture of how the business is actually doing.
All right, and this is where the plot really thickens. Operationally, it was a mixed bag, for sure. On the one hand, revenue came in at $389 million, which actually beat what everyone was expecting. Pretty good, right? But then you look at comparable store sales, and they fell by 6.5%. And that, my friends, continues a pretty worrying trend.
So let's put it all together. You've got some good stuff. Revenue beat consensus, gross margins expanded, which is great to see. Even their adjusted EBITDA grew a little bit. But then, the not-so-good stuff. Those comps were down, and here's the kicker. They lost about 160,000 residential customers this past year. That's the real problem, and it's exactly what management's new plan is supposed to tackle. Okay, so now that we've got the lay of the land, the good, the bad, and the ugly, let's talk about the turnaround plan. Because this right here is the real reason the stock popped.
So management came out with a really clear, really aggressive plan. It's got four main parts. First, they're closing down a bunch of underperforming stores and a distribution center. Makes sense. Second, they're going to invest in lowering prices to try and win back those customers they lost. Third, they're getting serious about cutting costs and getting rid of excess inventory. And finally, they've got a new CFO who's basically there to make sure everyone stays on track and watches the bottom line.
You could really feel the change in tone on the earnings call. It was all about urgency and taking action. The CEO basically said, "We know we're in a tough spot, and we are done waiting around." They're sending a crystal clear signal to investors that things are changing, and they're changing now.
And look, this isn't just a bunch of fancy talk. They're putting real numbers behind it. They're saying that all these changes, closing stores, cutting inventory, saving on costs, should add up to a $7 to $12 million improvement to their EBITDA every year. And that gives investors something concrete to hang their hats on.
But, of course, it's not all smooth sailing. It never is, right? We have to look at how this plan affects their guidance for the future, and more importantly, the very real risks that are still lurking. The path forward here is definitely a tricky one.
So if you look at their guidance for the next fiscal year, it kind of suggests things are going to stabilize. They're projecting sales somewhere between $1.1 and $1.25 billion, and EBITDA between $55 and $75 million. But just look at how wide those ranges are. That tells you even they aren't 100% sure how this is all going to shake out.
And that uncertainty leads us to what might be the biggest elephant in the room, the balance sheet. There's this metric analysts love to use called the Altman Z-score. To put it simply, it's a formula that tries to predict how likely a company is to go bankrupt within a couple of years. And anything below 1.8, well, that's a big red flag.
So, what's Leslie's Z-score? It's about 0.9. Yeah, that is deep in the financial distress zone. They're carrying a lot of debt, which means they don't have a lot of wiggle room. There's a huge risk that they just can't pull off a turnaround this complicated. And hey, if people stop spending money in general, that could just torpedo the whole thing. You know that fade we saw in the stock after the initial pop? That's probably investors starting to really think about these risks. All right, so we've looked at the good, the bad, and the risky. Let's put it all together. What's our take on Leslie's from here? Okay, here's the Talk Ticker's tick. Next quarter, we think those comparable sales will still be negative, but we're looking for them to get a little bit better as the new plan starts to kick in.
As for the stock price, we think it's going to be stuck in a range for a while, kind of a tug-of-war between hope for the turnaround and the reality of that weak balance sheet. So all that leads us to our rating, market perform.
Look, at the end of the day, Leslie's is a classic restructuring story. It's super high risk for sure, but management has given investors a clear roadmap. It's a difficult road, but it's there. The real question is, can they execute? The things to watch are pretty simple. Are they actually closing those stores? And most importantly, are those lower prices starting to bring back those 160,000 customers they lost? That's the whole ballgame.
And as always, this is not financial advice.